Hello and welcome to this AFM pre-September 2022 mock exam session. And today we're covering Arneson. My name is Alan Lynch and I'm your expert tutor for ACCA's question. And today we're going to cover the Arneson question, which is question 2 in the mock exam. But before we go through that, I'd like just to remind you of some of the key things that you might have heard in previous videos about how to best approach AFM. Don't think you always know. These are a couple of minutes that are worth taking note of, and this could be the difference between passing and failing. The first thing is that time management is always vital to pay attention to in AFM. It's vital in any ACCA exam. Remember, split the questions down along the time. If it's a 10-mark question, still spend about 18 minutes. Although you get some time back with the professional marks, maybe stick to that way first and then use the professional marks to fill in any gaps, reread your questions, tidy everything up, make it look as impressive as it can. Also, you can't pass an AFM exam without good narrative answers. It's a very dangerous thing to do is to assume that it's a numbers-based exam. And I've talked to students before who say, yes, I know the narratives are important, but they still fall down the same trap all of the time. Even if you don't get the numbers right, if your narrative is based on the numbers that you have calculated, if they're wrong, you've already suffered that loss when the examiner goes through your calculation. Make the narrative as good as it can be, and you're also building up those professional marks. Read the requirements carefully. Make sure you're addressing what the examiner is asking. Make sure you're always answering why. Make sure you're always going to the case study and explaining why it's relevant. If you find yourself writing lots of points that aren't relevant to the case study, all you're doing is regurgitating a book. You won't get marks for it. You will lose professional marks for it. And that's a real shame when you probably do have the knowledge, but you just haven't spent that extra 30 seconds thinking about the requirement. And finally, you need to have an exam strategy for the CBE tool. The first part of that strategy is to use that CBE tool all of the time when you're practicing ahead of your exams. The second part of that strategy is to come up with a layout and a structure and a process by which you deal with your exam every single time that you answer a question. You'll see my process, you'll see my strategy during this question. You'll see where I put the windows, that I still have access to the exhibits, that I have lots of windows open all of the time. You can use that as a guide if you wish, but come up with your own strategy. That working in the CBE tool is just second nature on the day of your exam. You've enough to think about the questions and general exam stress. You don't want to be thinking about how do I use the tool properly? What buttons do I press? That should all be second nature. If you think about it, in previous exams, you never taught you how you wrote with a pen and paper. You need to get to that stage where the tool is an extension of how you think, and working around using the mouse, using the keyboard is no different than you using a pen. Now we're going to move on to the more detailed solution around Arneson. So now what we're doing now is we're using our word processor and our spreadsheet to answer the questions. I mentioned earlier having a strategy. If you look now, I have my word processor on one side, my spreadsheet on the other, because often in AFM, you'll be required to have the two of them working together. I have easy access to all my exhibits. And when I open them up, I can have them on either side. So if I'm using them for my word processor, or I'm using it as a guide for my spreadsheet, they're within easy access. The first thing I do is I open up my requirements and I copy them in. And it'll take a second just to lay out, but as you can see, I have taken in my two requirements in this question. Requirement number A is discuss the possible sources of synergy arising from Arneson Company's acquisition of Burke's company. What do I know already? 2 to 3 good points. Don't go over the top. It just won't help. You'll be wasting time. You've only got 4 marks. So any more than 3 good points here, and even 3 is probably pushing the limits of what you need. Part B, estimate the percentage gains to the Arneson and the Burke's company shareholders under each of the 2 offers. Comment on the answers obtained and the position of each company shareholders. So you get up to 5 marks for that discussion. So 11 marks for calculation. So be careful, don't spend too long on the calculation. You're probably looking at about 20 to 22 minutes. Leave appropriate time for comments, no more than 3 points per company. It's only worth 5 marks. So if one of those points is a bit not quite right or not in the right area, at least you've got 3 and 2, and you'll probably still get certainly 4, if not 5 marks. Looking at your 5 professional marks, they're for analysis and evaluation. That's using the data, discussion and recommendation. For the skepticism professional marks, you challenge and critical assessment, and we'll see that later on. And then commercial acumen is using examples to illustrate the points around the synergies. So don't just say a typical list of synergies from a textbook. What are the synergies that are related to this scenario? So we've looked through our requirements. And again, this all happens quite quickly, not in the, I'm taking you through it slowly. Now we look through our exhibits. We see that Artisan is a listed wholesale company in the grocery sector. It's becoming increasingly competitive. And the customers continue to demand low prices. It has decided to vertically integrate into the grocery retailing sector. We have a second exhibit. And in this exhibit, the directors have identified a small chain of supermarkets, which is Burke's company, that could be acquired. There's initial conversations that are encouraging, and the directors of Burke's think that the shareholders would like the culture and ethos of Artisan and would be open to the possibility of a takeover. In recent years, there have been several mergers and acquisitions in this sector, and the premiums to the shareholders have averaged approximately 20%. There's 2 offers being considered, a cash offer of $240 and a share for share exchange, which is 4 shares in the combined company for every 5 shares in Burke's company. And then finally, some of the financial information. Artisan has 100 million shares in issue, trading at $3.35 a share, and had earnings of 27.92 million most recently. Burke's has 60 million shares in issue, earnings of 11.6 million in the most recent year. It's an unlisted company, and it should be assumed that the suitable PE ratio for Burke's is 10% lower than Artisan's PE ratio. If the acquisition is successful, the directors expect that post-tax synergies of 2.98 million will be achieved, and that the company's combined PE ratio will be the same as Artisan Company's PE ratio before the acquisition. So that's all of the financial information. We're now going to look at just part A. So we don't need our spreadsheet. We can leave it there. We can remove it if you wish. It doesn't really matter. There's nothing really in the question that we don't know very quickly about the synergies. So let's have a look at the solution. So if we go down further, and remember, always be professional. Part A, discuss the possible sources of synergy arising from Artisan Company's acquisition of Burke's company. Remember what I've mentioned before, 2 to 3 good points. In this solution, we have many points. If you pick the first 3, the second, third, and fourth, the last 3, any of these 3 will easily get you those 4 marks and you can move on. The directors expect that post-tax synergies of 2.98 million per year will be achieved. When combining the grocery wholesaler and retailer, the likely sources of this synergy are discussed below. Remember, be professional. What is this answer about? What are you introducing here? You're introducing that you're going to provide the benefit of synergies. So what are those benefits? Artisan is a large listed company and Burke's is a smaller unlisted company. So it's likely Artisan will be able to attract highly qualified and competent managers that might be able to improve how Burke's company is being run. The Artisan's managers might have better strategic planning skills. There might be knowledge of potential investments or financing opportunities, again, benefiting Burke's company. Future cash flow of the 2 companies are not positively or perfectly positively correlated. So therefore, if one goes up and the other one goes down, it might provide stability over time, and this could make creditors a lot happier, maybe avail of discounts and cheaper financing costs. A bigger company will have greater bargaining power and therefore will improve the profit margins. A wholesaler taking over a retailer is vertical integration, and we were told that in one of the exhibits. And this can each increase profits by cutting out the middleman. There are economies of scale, reducing costs when the 2 companies combine by duplicating central services such as finance, head office costs, management costs, and economies of scope. For example, savings in marketing costs created by joint advertising campaigns. Now again, remember, see the way that question is laid out, see the different little paragraphs for every single point. Don't use bullet points. 2 to 3 of any of those points were more than enough to get you those 4 marks, and you move on to the next section. So now let's move on to part B of the question. So in part B, we know what we're doing. We're doing estimating the percentage gains to Artisan Company and Burke shareholders, and under each of the 2 offers. So what I've done in the spreadsheet is I've started building up a template that you could use. I'm going to take you through the calculations and the answers. And then in red on the right-hand side, it's just some of the workings. You are not required to provide these workings in your exam because you can do the calculations within the cells, and I'll show you that in a second. But this is just for when you can use the video a little bit later on, when you can come back. You can track back from the exhibits where all the numbers come from. So what we'll do is we'll open up the exhibits, and you can see they're quite small, so we can change them here and use the different versions. So you can do page fit, page width. Let's make them a little bit bigger, so not that big. So there we go. We can read them like that. And again, we're going to need exhibit 3 here, so we can just use in that size as well, just so you can see the videos a little bit bigger. So what are the exhibits saying to us? Well, we've already looked about the chain of supermarkets that they have and the possibility of a takeover. You had some share price information there as well. And then in the third one, in exhibit number 3, you see that there's 100 million shares in issue, trading at 335, and the earnings figures and all that information we went through a little bit earlier. So what we're trying to get to is look at the percentage gain to each of the shareholders under each of the offers. We have a cash offer and we have a share for share offer. And we know there's gains to go in here at the very end. So how do we go about that? Well, first of all, there's a number of workings we go through. Remember, we're looking at the companies individually, we're looking at the companies together, and what we're trying to gauge here is what is the benefit to the shareholders of the individual companies if this merger goes ahead. So look at the company values. First of all, Arneson. Arneson's pretty straightforward because it's a publicly limited company. It's 100 million shares. The share price on the right-hand side here is $3.35 per share. So 335 million. As you can see here, I've put the calculation inside the cell here. I would encourage you to do that as much as you can. Don't put them on the right-hand side here like I have done. That is just for showing you for this video. But putting them in the cell, the examiner will be able to see all of your logic. And in fact, later on, you'll see I've linked cells. And that's a common thing to do as well. So now Arneson has done what we're going to look at is looking at Burke's company. And Burke's company, we're given information about the PE ratio. So it's very clear what we're going to use here. We're going to use the PE ratio. And again, we're looking at the PE ratio multiplied by the earnings. We are told that it should be assumed that a suitable PE ratio for Burke's company is 10% lower than Arneson's PE ratio, or the other way around, it's 90% of it. So when we're looking at the PE ratio for, and again, the details are in the cell and they're also on the red part on the right-hand side. What we do know is that the PE ratio for Burke's company is 90% of what it is for Arneson. What are we looking at Arneson here? Well, we know the share price is $3.35, and then we divide that by the recent earnings divided by the number of shares, or the earnings per share. So it's the share price or the trading price divided by the earnings per share, and the earnings and the share numbers you're given. So 90% of that is 10.8. So the PE ratio for Burke's company is 10.8. Now, what's next? The 10.8 is our ratio multiplied by the 11.161 million. So again, look at that. It's a PE ratio multiplied by the earnings. So 10.8, which is the PE ratio we've calculated, multiplied by 11.61, which is the earnings of Burke's company, which is equal to just under 125.4 million. And again, on a per share basis, it is the number of shares. And again, see how I've linked them here? The 125 million divided by 60, or 60 million shares, as we've seen here on the right-hand side, giving you a share price of 209 per share. Now let's look at what happened if we look at the combined company. And that's the PE ratio by the earnings. Now, what do we know that the PE ratio is? Well, we have calculated the PE ratio for Burke's company, but actually we calculated the PE ratio for Arneson as well. The PE ratio for Arneson is 10, so therefore 10.8. So therefore, the PE ratio for Arneson company is 12. And again, that 12 comes from the 10.8 grossed up to being 100%. So what is the value of the combined company? Well, we have our PE ratio of 12 multiplied by 27.92, which is the earnings for Arneson, plus the 11.61, which is the earning for Berks, and plus the 2.98 million, which are the expected post-tax synergies in the exhibit that you have. So 12 times those three numbers added together gives you 510 million. So what is total synergy? Well, our total synergy is 510 million minus the 125 million that we have for Berks Company, minus the 335 million we have for Arneson Company. So our total synergy, or total improvement in the value of the combined company versus the companies individually, is just under 50 million at 49.73 million. So now let's look at the two offers. The first is a cash offer. So the cash offer is $2.40 per share, but we know that Berks Company are $2.09 per share because we've calculated that already. So therefore the gain is already 31 cents per share, or 31 cents multiplied by the 60 million shares that are in issue, which is 18.6 million. So the shareholders for Berks are 18.6 million better off. The shareholders for Arneson's is 49.7, which is the total synergy minus the 19.6 million. So when we take away the 19.6 million, we see that the value for Arneson is 31.1 million. Berks Company is the 18.6 million. The total is the 49.7. So therefore, we have 31 million, 18.6 million, which is a gain of 9.3, or a gain of 14.8 for Berks Company shareholders. Now we look at the share for share offer. A 4 for 5 offer means a 4 divided by 5 multiplied by 60. So that means for every 5 shares you have in the company, you're going to get 4 in the new company. So instead of the total shareholding being 60 million, the total shareholding will be 48 new million shares will be issued in the new company to pay the shareholders in Berks. So the total shares in issue will now be 148 million. It'll be 100 million from Arneson plus the 48 million new shares. The value attributable to the Arneson shareholders is 100 divided by 148. So it's the 100 million shares from Arneson divided by the new total of 148, multiplied by the 510 million, which again is the value of the company, is the total value of the combined company, which is equal to 344 million. And then the value attributable to Berks shareholders is 165 million, the balance between the 510, or you can go to the same process and say 48 divided by 148 multiplied by 510. So therefore the gain for Arneson is the 344.7 minus the 335, which is the original share value, which was the 100 million shares multiplied by the trading price of 335. We have the Arneson number of 165 minus the 125, the value that we calculated earlier, giving you 40, giving the improvement of 49.7. And when we calculate that as a percentage, which is we get 2.9% and 31.9%. So what is the final answer here? Well, the cash offer, and we can link them directly in. So for a cash offer, we are 9.3% better off for Arneson. Again, we can just tidy up that, and we can drag that across, and you'll get the answer of 14.8 for Berks, because you're just dragging it across, you're feeding the same cell. And then similarly, when we move down here, it's the 2.9% for the share exchange. Again, using these, tidy everything up, dragging that across, and you get 31.9%. So now what we've done is we've calculated the percentage gain. What we have left to do then is to take the position of being the Arneson shareholders and the position of being the Berks shareholders. So let's close out that, and we don't need that. So now we have estimated the percentage gain under the two offers. Now we have to comment on the answers. So now let's have a look at the position of the Arneson company shareholders. So they make a smaller percentage gain, than the Burke shareholders. If you think 9.3 versus the 14.8, and 2.9 is a much smaller gain than the 31.9. But however, this is very common in an acquisition, and a larger premium generally has to get paid. So it's not uncommon, and they're still better off. Again, at first glance, you would think they would prefer the cash offer because they get to 9.3%. But however, the cash offer will need funding. So yes, they're better off, but then they might have to borrow money for that. If they're borrowing money, then you're having extra risk, and then the profit will be impacted, gearing will be impacted, and you have maybe longer term interest commitments. The share for share exchange gives a very low percentage gain and will dilute the shareholding, so that looks unattractive as well. So it's not really a great offer for Arneson. From a Burke's perspective, the shareholders will make a smaller gain under the cash offer, but still relatively healthy. And then that might think that the cash offer is unacceptable. But the cash offer might be preferable to the share exchange. It's transparent, it's known, you're not depending on the future performance of the company, and there's the risks that come with that, and there's no guarantee that the synergies will be achieved. Also, the preference of the Burke shareholders, whether they prefer to take the cash now and cut their ties with the company completely, or take the shares and then remain part of a larger company. Again, their influence might be diluted as well. So to deal with all these issues, you can present a package which will appeal to all shareholders. Arneson could offer a choice of cash or shares as part of the acquisition. So that means that the Burke shareholders have a choice. Some might choose cash, some might choose shares. And from an Arneson perspective, that they might get a better return if more people choose cash. And also, they're not investing all of that cash, so therefore they mightn't need all of that borrowing. So again, just 2 or 3 points on each one to support the 5 marks. And again, you've addressed a lot of your professional marks. We've analyzed and evaluated, we've used skepticism, and we have commercial acumen by giving them advice. Like, look at this advice you're giving them here, presenting a package. That's something that's very commercial. That is something that the examiner will respond to really, really well, and you will really pick up those professional marks. So what do we have left to do for the examiner? Well, you have presented your 2 answers, but you kind of need to tidy all this up. So what we're going to do, so any notes, and obviously I have a lot from earlier on, we're going to delete all of these notes and we're just going to start. So part A, again, clearly marked with part A, you have all your points. Look at the layout that I've used. Each point is very clearly written. There's gaps in between. Very easy for an examiner just to effectively tick them off and give you all the marks. Remember, you don't need all of these points. Only use the amount of points that match the amount of marks. Part B, again, we don't need any of that. We're only letting the examiner know we're doing part B. We've obviously highlighted part B over in our spreadsheet here for the calculation. And then we've clearly labeled the position of Arneson Company shareholders and made our 3 points. The position of Burke Company shareholders and made our 3 points. And finally, we've given our opinion. We have said they can present a package that will appeal to all shareholders and a choice of both. So then your commercial acumen also comes into play, and we can delete our note about the professional skills. And again, tidying this up, just giving the examiner exactly what they're expecting in the exam of what you have written, nothing to do what they have written. Don't try and beef up the words or copy in part of the exhibits. This is all your content. This is everything that you've written. Make it easier for the examiner and make it very difficult for him not to award you all of those professional marks as well as all of the marks for the content.